Hello and welcome. Today I'm going to talk about YETI Holdings Incorporated. So chances are you're well aware of this company and the high value coolers and tumblers that this business creates. Today I'd like to delve into it as a potential stock market investment because it seems to be profitable and a high margin business that might be undervalued today, depending on how you look at it. So today I'm going to talk about its overall financial health, primarily its long-term performance, as well as my opinion of the valuation based on the numbers I'm looking at. As always, it's just an idea, not investment advice. So in case you're not familiar with YETI, I'll just back up for a second. They're a global designer, distributor, and retailer of things across categories, including coolers, cargo boxes, bags, outdoor living products, as well as drinkware, tumblers, mugs, water bottles, and pretty much everything under that umbrella that you can think of for the most part. They're known for their durability and high quality, which is reflected in the price of most of their products and the willingness of people to pay these prices, which seems like kind of a good thing when you're looking for a high quality business. Is this the Apple of coffee mugs? Well, at least that's the first thing that came in mind for me. Anyways, let's continue. Before I get into my valuation and why I think the price has come down, let's talk about the current financial situation of the business, and we'll start with revenue. So revenue seems to be continuing to grow, if not at least holding very steady, with a long-term revenue growth rate around 20%. Gross profit margins have averaged around 50% going back about 10 years, which is extraordinary. And this makes sense when you consider that you're paying $50+ for a coffee mug. Yes, it's a good one, but there you go. A return on equity of 28% is also a solid number. This is the net income divided by total shareholders' equity. And just a friendly caution, this is using net income. By using more leverage, a business will come across with a higher return on equity. But looking back at the debt position, YETI does not appear to use too much debt, as the current ratio is at about 2.3, and the quick ratio is at 1.45. And this means that there's more than enough cash and other liquid assets compared to the debt that this company holds. I'd also like to note that the return on invested capital, or ROIC, is just under 29% against a weighted average cost of capital of just under 15%. This again speaks to the quality of the business, where it's able to generate higher returns on investment than the cost of raising that capital. Looking for high quality businesses to invest in, this is a good number to look at, which can weed out companies that are borrowing a lot of capital and spending enormous amounts of money on things like innovation, but not actually bringing in the revenue that they should for these investments. And this is unfortunately more common for some of the big businesses that get a lot of publicity. So why did YETI come down from highs of $107 back in 2021 and is now hovering around $30 to $50? Obviously, there could be larger macroeconomic factors like interest rates, wars, etc., that bring down the entire market and weigh down on investors' confidence that people will spend money on high value items like some of the products that this company produces. There was also an issue at the end of 2023 where there were high hopes for a new cooler product launch that did not meet expectations and ultimately had pretty soft sales. This was a big disappointment and perhaps scared investors who were excited about new innovation and were continuing to look for growth in this business. I don't really think this damaged the long-term outlook of YETI, and more importantly, I don't think it did brand damage, which is still very, very strong, the brand, and still projects a very high quality of products across many different categories that are well designed, durable, and people will love. So at least from what I can tell, the price decline may have a lot more to do with macroeconomic factors than it does with any meaningful decline in the business. Speaking of valuation, let's mention the GF value indicator. So this is unique to Guru Focus, but it gives us a really good clue when we want to look at overall valuation. It seems to factor mostly value investing principles, where historic multiples like PE and PS are factored together with past returns, as well as growth, and also looks at future estimates of performance. This gives us a nice range that we can look at as we continue to look a little deeper into this analysis to figure out valuation. Today, it gives us a fair valuation of about $53.33. That means we're about 30% undervalued at the moment. In addition to anticipated growth, which, as we discussed, is pretty strong, let's take a quick look at the discounted cash flow model too, because this is one of the most important ways that we can look at value investments. There are a few variables that we need to consider here, but we can make a few assumptions to see what we might think a fair value might be. Because an almost 28% 10-year growth rate for YETI, this model gives us a fair value of $71.35 when you add the tangible book value. If you adjust the 10-year growth rate estimate and bring it to about 15% for the next 10 years, you still get a fair value of $52.83, which is around where the GF value indicator has us in the first place. This tells us there is roughly a 30% margin of safety. Again, if you're investing for the long term, you're still taking advantage of the growth in the fair value, which could propel this investment even further. So let's remember that one of the most important takeaways from this calculation is the margin of safety that helps us not lose money, which is rule number one. And here's my biggest takeaway after looking at YETI briefly here. It seems to be a very high quality business that will be around for many years, selling high margin products under a very valuable brand. If it is at least decently managed, it'll hold its place among the consumer marketplace's strongest brands that can maintain large profit margins into the future. It also does seem to be undervalued at a glance, and this definitely deserves a look if you're looking for a high quality business at a fair price. So I hope you found this helpful. Thank you again. Have an amazing day, and we'll see you soon.